site updates, Gamma Exposure Tool. To the Signature Tools tab, this is a new tool that we just added. So we go to Signature Tools. We have a variety of different one-off, market important, relatively, signature tools. The Volatility Skew tool. See the difference in implied volatilities of options in the same expiration cycle, or the curve of the volatility skew on the same stock, comparing options at the same strike going further out in time. Market sentiment, I mentioned, we're going to talk on that in a minute. The spread chain tool. This is a great way to just evaluate bearish or bullish spreads, building iron condors even, or comparing the parity trade of, say, a bull put credit spread to a bull call debit spread, seeing which one can give you the best bang for the buck, or bear put debit to bear call credit spread on the same security, one security at a time, with about 4 or 5 broad basic criteria that you can put in. The long option finder, very powerful tool. Hey, I'm thinking certain stock is going to go. I think AMD has the possibility of moving up another 4 or 5% in the first couple weeks of January. What would be the best call to buy if I think by January 10th, AMD is going to be up another 4 or 5%? Well, I just go to the long option finder tool, put in AMD, put in my target price, my investment amount, and it'll show me which call would give me the best return if the stock gets to or hits my target price by my target date. The Stock Repair tool. If you've just been trading stocks for years and you're just getting into options, you're saying, hey, well, you can repair an options by just selling calls against it and make that back over time. Well, the Stock Repair tool is a faster way to use options to get back to break even if you own a stock that's fallen in price and you think it's bottomed out, maybe using MACD. That's what I use when I see a MACD bottom. That's when I make some adjustments on my married puts, following the rules in the blueprint. But hey, I was in a stock, it fell. I think it's bottomed. I think it's coming back up. I could just sell calls here using these options to try to get $1, $1.10 back maybe every 20 to 30 days and help that cut into the $8, $9, $10 loss that I have on the position. What the Stock Repair tool does is it shows you an options trade that can help you get back to break even faster. Now, it's using a ratio call spread, but because of the structure of you already owning the stock, it's simply a covered call with a bull call debit spread, where you also get the power of the profit of the bull call debit spread if the stock meets your expectations, and you can get back to break even with a $9 loss with maybe only a $3, $4, or $5 move with the Stock Repair tool. Stock insurance, you've got a stock that's moved up in price. You want to lock in your gains, have a bulletproof position with no risk, and still continue trading it for an extended period of time. This will show you which is the best put to buy in order to do that. The Strike of Pain tool. Now, this is a pinning tool. It's based on the max pain calculation that's been around since the 80s. And looking at values of open interest times the amount that a call or put is in the money or out of the money, it shows a pain value. And the pain value is believed to be where option buyers would lose the most money and option sellers would make the most money. And the theory is that during that time, mid to late 80s, is that investors saw stocks gravitate towards these prices where the pain for the option buyers was the greatest and the benefit for the option sellers was the highest. And that's what the Strike of Pain tool does. And we'll talk about that with the Gamma Exposure tool. The Unusual Option Volume Report. Again, simple look, see which stocks have larger than usual trading today. You see that first step on the pod that we just talked about a few moments ago. This is a little bit more in-depth look. And then, of course, stocks with upcoming ex-dividends, if you use that for your trading. I know I have some PowerOptions subscribers, a handful, that use just in-the-money covered calls with stocks that have an ex-dividend coming up, hoping to be assigned early and make the maximum profit as the call buyer wants to get in for the dividend if the time value of their call is less than the dividend payment that's going to be made. So I have some in-the-money covered call traders. They do in-the-money covered calls maybe 30 days out, where the ex-dividend is in the next 7, 10 to 15 days, hoping to get assigned early, take the max profit, and then move on to the next position. Gamma Exposure, though. All right, Gamma Exposure. This came to us from a customer who wanted to know, hey, this idea It's been around for a while, but it's been building in popularity over the last maybe year, especially in the last 6 to 8 months. And it's been fairly important. It seems to be fairly important and fairly used by investors who are trading butterflies, iron butterflies, and iron condors daily. The zero data expiration on SPX, NDX, SPY, for example, or other options. Those are really the main ones that offer the daily options. So it's fairly simple. Let's just take SPX here. And it's got to load all the dates for a moment here. So I'm not going to do December 5th. Let's go Monday. Essentially a zero data expiration. We wouldn't open the trade today. We'd open it on Monday. But let's see what's going on December 8th. Let's just hit submit. Now, if you've ever looked at the max pain calculation, or our max pain tool, strike of pain tool, excuse me, based on the max pain calculation, the setup of this is going to be fairly similar. What I mean by that is the view of this is going to be fairly similar. We have SPX at 6,870, 6,870 and 40 cents. Let's just call it 6,870. All right. And what this is doing is looking at the strikes that we have available, and it's looking at the bullish or bearish gamma exposure for this particular stock. Now, there are bearish bets. What is this telling me? This is telling me that based on the gamma structure, the gamma exposure at this strike of 68.50, there's some people that are betting on a bearish move that SPX will be dropping down to 68. I know it's only 20 points. It's nothing, right? But right there, that you see a lot of bets on the bearish move. But the highest gamma exposure is in the bullish range, and it's at the 6,900. Now, that's at the close today, using the gamma exposure of all the different gamma calculations of all the different options for Monday's expiration. The idea is that using this tool, hey, this is a pinning tool. I think that maybe Monday, based on what the market is showing us right now, knock on wood, we know it's going to change with after hours trading. We know it's going to change with news over the weekend. And that's why you look at this, sort of 10, 15, 20 minutes after the market opens to get an idea of the gamma exposure for that moment. That's how most people, as I've understood, as I did my research this week, are using the GEX here to find that. So if I logged in on Monday, 10 or 15 minutes in, and I see a target price of 6,900, SPX is at 68.70. The idea is, and this is not a recommendation or suggestion, and this is not something I'm doing in my account, is that I might open, let's say, a butterfly position, whether it's an all call, all put, maybe an iron butterfly, targeting at that moment the 6,900 as the point, and my outer wings might be, 10 points away, maybe 10 or 15 points away, depending on what my risk exposure is, my risk tolerance is, ladies and gentlemen. Excuse me. So that's sort of how investors, but if you think it's bullish, you want to take a little bit of a bet, you think it's bullish. Hey, the market opened up here. I see my gamma exposure, my GEX right here is at 6,900, and I'm in the bullish range, obviously, because it's above the current closing price. But I'm bearish, and I think based on the news that came out of the weekend, I think a good target here might be this 68.50. Well, you might take that little bet, butterfly or perhaps a condor, around the 68.50 price. Again, depending on your risk tolerance, depending on your expectation, it's not as high, of course, as the peak, as the GEX number. But I'm seeing a high value of red here, and if whatever news comes out, I look at this 10 or 15 minutes in, I'm doing some of these zero data expiration trades, the condors or the butterflies on SPX. I can use this as my gauge as sort of what is the market expecting. I apologize, folks. What is the market expecting as a target for that? That's what this is showing. That's what the gamma exposure is looking to do. Now, hold on one second, folks. Excuse me. All right, excellent. Wet that palate a little bit. I mentioned that this is the similar view. We just programmed it this way because we already had the graphics and the functionality and the coding for what we call the strike of pain, the max pain, based on the max pain calculation. So, oh, sorry, folks. Oh, get out of that. Oh, is the max pain very different? Let's take a look. Let's go to Signature Tools, and let's go to Strike of Pain. We're going to keep with SPX, and I'm going to look for the Strike of Pain for our same date on Monday. Now, I don't know if this is vastly different. I'm just curious because I've never compared these two. So we saw the highest value. There's a lot more values here. We saw the highest value on the bearish end at 68.50, if I'm not mistaken. So we're seeing some low pain values here, but we're going down. I want to go to this using every strike, so that's why it's much bigger. 68.20. That's the strike of pain. And again, does that mean that's the price where you should target? Again, the old idea from the 80s, using the max pain strike of pain calculation, was saying this is a price that based on the in the money, the options of the in the money and out of the money value calls and puts multiplied by the total open interest would cause option buyers to lose the most money and option sellers to make the most money. And here we are at a pain value here of 898. I'm sorry, the monetary value. That's what that middle column is. I apologize. The middle column there, that is the pain value. All right, so that's the highest or the lowest value. Right, we're entering into these values here. Sorry for the scrolling, folks. Okay. So right here, the lowest value. That's where option buyers lose the most money and option sellers theoretically make the most money. It's believed that that's where the stock would gravitate towards. The index, in this case, the underlying index would gravitate towards a pinning tool, similar to the gamma exposure. It's being used as a pinning tool. Our 68.50 strike we saw in the bearish is about, 6 million away from the 68.20. Moneyness times the open interest of the calls and the puts, where option buyers lose the most money. Index might gravitate towards that price. We saw the high bearish mark here of the gamma exposure 68.50, but then again, we saw the highest bullish range up here at the 6,900 level, right? That's where we were on the other tool. So there is a subtle difference here. It's interesting. I'm going to jot these numbers down. Well, I don't have to jot these numbers down. We've got it archived for preservation for our conversation. So we're going to see just on Monday where those end, based on the strike of pain and based on the GEX, the gamma exposure index.